You've been told banks are simply institutions neutrally serving depositors, lenders, and the economy. But what if that's wrong? What if modern banking wasn't built by happenstance, but by a select handful of families who shaped it, designed it for a purpose far beyond simple deposit? What if the vaults you see are not just filled with money, but with legacy, power, and control? Today, we dive into the hidden corridors of finance, tracing the secretive families who engineered the banking system we live under. Not by accident, but by design. We'll uncover origins in medieval Italy, rise through war finance and empire, breaking points when those dynasties nearly collapsed, the fallout that reshaped the rules, and the failed fixes that still echo today. By the end of this journey, ULL see modern banking in a radically different light and ask, who really runs this system and for whose benefit? If you think banks are boring, think again. To understand modern banking families, we go back much further than you might expect. The story begins in the medieval Italian city-states, places like Medici Bank in Florence, the Bardi family and Peruzzi family. In 14th century Florence, the Bardi and Peruzzi families were at the vanguard of banking innovation. They were lending large sums to kings and nobles across Europe, developing credit instruments and branch networks that would foreshadow modern banking. The Bardi lent Edward III of England about 900,000 gold florins, a huge sum, which ended up unpaid when war and debt collided. That failure brought the Bardi Bank down. Similarly, in 1397, Giovanni de' Medici founded the Medici Bank, which became the largest and most respected bank in Europe in the 15th century. What we see here is more than simple lending. We see families becoming financial institutions. We see trusts, branches, networks, instruments, and importantly, control of credit. These families weren't just rich, they were system builders. Credit becomes power, money becomes influence. Banking becomes the invisible backbone of governance, trade, empire, and the families behind it, the unseen architect. Once the foundations were laid in Italy, the story quickly expands. The families that mastered banking in one city or region began branching out. They adapted to new contexts, wars, colonial expansion, industrial revolution. Take the Rothschild family. Founded by Mayer Amschel Rothschild in Frankfurt in the late 1700s, the Rothschilds built branches in London, Paris, Vienna, and Naples. Through loans to governments during and after the Napoleonic Wars, investments in railways, mining, and emerging industries, they became one of the first multinational banking dynasties. Similarly, Northern Europe, then the emerging United States, saw families like the Smith family of England banking since the 17th century become embedded in national financial systems. These families leveraged networks, marriages, branching out internationally, and war finance capitalizing on governments borrowing to increase their influence. They became not just banks, but power brokers behind crowns, treaties, and trade. The rise of central banking also intersects here as states realized the need for organized credit and banking support. These families were often the intermediaries, controllers, or prime movers. Banking moved from local merchant finance to global power tools. By the end of the 19th century, we see the banking families not just as financiers, but as systemic actors, shaping railways, industry, empire, even governments. With power comes risk. Many of these dynasties faced near catastrophic collapse. The breaking points in their stories are revealing. Remember the Bardi and Peruzzi War, default, and collapse. Even though the families had been powerful, the fragility of credit and the exposure to sovereign risk destroyed them. The Rothschilds too faced systemic shifts. By the late 19th century, their dominance was challenged by the rise of joint stock commercial banks and changes in regulatory, political, and technological environments. Consider how banking families had to navigate wars, depressions, technological change, and political upheaval. Their networks were global, meaning an event in one land could ripple to their interests everywhere. In the 20th century, the concept of crisis broadens. The Great Depression, world wars, shifting regulatory regimes. Now, these families either adapted or risked extinction. Some did, some didn't. At these breaking points, the system itself was exposed. Banking was not just finance, it was infrastructure for power. And when it failed or was challenged, great wealth and influence were put at stake. From those crises emerged reforms, regulation, and restructuring. But for the families who had built the system, the fallout was both threat and opportunity. After the 19th, early 20th century upheavals, banking systems were formalized, central banks emerged, deposit insurance, nationalization in some cases, tighter regulation of banks and banking activity. What this did was change the rules of the game. Yet the families who had the networks, the capital, and the influence often repositioned themselves into the new order. They shifted from pure merchant banking to investment banking, from hands-on banking to advisory, from domestic to global. The legacy of earlier dominance gave them the advantage. For example, some families moved into asset management, private wealth, and cross-border banking. They diversified. They became less visible but remained influential. The new order thus carried the legacy of the old, while banking seemed more regulated and formalized. The power networks remained only hidden under new layers of regulation, globalization, and financial innovation. Critically, the fallout also meant failed fixes. Disasters like the 1929 crash, the stagflation of the 1970s, the 2008 global financial crisis. Each time reform appears, the same vulnerabilities emerge: leverage, interconnectedness, too big to fail banks, shadow banking. The families of influence often survive. The system's flaws persist. Now let's bring this to, today. The story isn't done. It is evolving. We still have powerful banking families or their successors, global finance, and patterns that echo the past. Consider that the global debt today is in the hundreds of trillions, that banks and financial institutions are deeply interconnected, that crises still follow similar shapes: boom, debt buildup, collapse, bailout, consolidation. Even if the family bank looks different, multinationals, conglomerates, investment banks, the structure echoes: capital, network, influence, generational continuity. The Safra family of banking origins, a dynasty with roots in Ottoman trade caravans and Sephardic banking, who now own major banking and real estate interests globally. The way banking regulation reforms appear after crises, but vulnerabilities remain: too big to fail banks, shadow banking, digital banking. The system still carries the DNA of those early families. Credit expansion, risk buildup, crisis, consolidation, new cycle. And here's a shocking data point. According to historical research, banking families like the Rothschilds influenced multiple governments, financed wars, and shaped railroads, mining, and industrialization. In short, the system built by those families continues, just with different names. Different tools, but same mechanisms: influence, network, capital. The question is, who holds those levers today? Each era has brought reforms meant to prevent the next meltdown, but each time, the system found a new vulnerability. The fixes failed for reasons that often tie back to those very families or networks influencing the system. In the early banking era, the response to sovereign defaults like Edward III was tighter credit practices. But that didn't prevent later systemic banking collapses. In the interwar era, the creation of central banks and deposit insurance seemed to stabilize banking, yet still the Great Depression occurred. In the latter 20th and early 21st centuries, deregulation and innovation derivatives, shadow banking, global capital flows were meant to expand opportunity, but again, they seeded crisis. For example, 2008. The reforms post-2008 stress tests, Basel Accords, Dodd-Frank aimed to constrain systemic risk, yet new vulnerabilities emerged: fintech, digital currency, less regulated sectors. It seems every fix is designed under the model created by those early banking families: networked capital, influence, credit creation, leverage. The system isn't broken so much as reinventing itself under the same logic. So why do the fixes fail? Because they treat symptoms, not the architecture. Because power remains concentrated. Because the same dynamics: credit expansion, risk concentration, bailout pads, consolidation, are embedded in the design. The question once again becomes, who designs the system and who escapes when it fails? If the banking system was engineered by influential families and their networks, and if the patterns repeat, the implications are profound. The average citizen may think banking is safe, regulated, fair, but the underlying system may still favor continuity of power, not broad resilience. Crises may not simply be bad luck or market failures. They may be the inevitable ripple of the system's architecture. When we talk about banking reform, systemic risk, or financial stability, the conversation may overlook who holds structural power, why networks persist, and how multi-generational influence shapes outcomes. For you, the viewer, this means being aware of banking isn't just about your account, your credit score, or your interest rate. It's about the architecture behind those numbers. It's about who sets the rules in which structures persist quietly. When banking reforms are announced, when new regulation is passed, ask, does this change the architecture or just the banking power is generational and structured? The families who forged modern banking, Medici, Bardi, Rothschilds, ET&C did not merely accumulate wealth, they built enduring networks, credit systems, and influence. Their legacy is embedded in today's banking institutions. Crises are embedded in the design, not just accidents. Because banking architecture relies on credit expansion, risk transfer and consolidation, systemic risk is when collapse happens, it often benefits the structurally powerful, those who manage the system, rather than simply participate in it. Reforms often change the rules, not the controllers, while regulations and oversight are necessary until the architecture of power, network, and generational capital is addressed. Vulnerabilities and consolidation remain. The same patterns, boom, bust, bailout, dominance, persist under new guidelines. Here's the warning. The next transformation in banking might look benign. Digital currency, fintech, decentralized finance. But what if it simply shifts control to another generation of networks behind the scenes? If today's banking architecture is influenced by legacy families and structures, tomorrow's could be shaped by global capital conglomerates or unseen generational networks. The open question, who will shape the banking architecture in the next 50 years? And how much of the system will be visible and how much will remain hidden? You've been told banking is neutral, but now, it's built, it's designed, and those who design